Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Trading Covered Calls and Short Puts. And, in the spirit of the season, we're looking right at Halloween around the corner. I thought, let's talk about the dark side of trading covered calls. It's seen by some traders as a very conservative, income-oriented strategy. But what are the risks that might be hidden in that strategy? We're going to be talking about three of those risks. And there's going to be a plot twist. We're also going to be talking about three potential virtues of the strategy. For some traders, that's plenty for them to still consider it to be an essential part of their portfolio. We're going to be weighing the pros and the cons, a lot to discuss. Before we can get to any of that, though, let me first of all say hello to everybody who's chatting out there in YouTube. Great to see all the familiar names, as always. Hello there, Posh and Eva, Mark, Kevin, KJ Herman, hello, good to see you, and Lawrence and Kelly and Willie and everybody else. Thanks for joining us week after week. We always do appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, we'll enjoy the recording. That's a great way to watch these webcasts, but you're also invited to join us in the live stream if you'd like to be here. This is a Monday webcast series. We always kick things off promptly at 2 Eastern time. Now, as a treat for my live audience members, we also are joined today by my very good friend, Barb Armstrong. Barb's going to be hanging out in the chats. She's going to be addressing any questions that I can't get to just during the flow of the presentation. So thanks for having my back there, Barb. Now, Barb and I would like to issue an invitation to everybody listening. If you have an account on X, you should be following your favorite Schwab presenters there on X. You can find Barb there at Barb Armstrong CS. You can find me on X at Cameron May CS. And if you reply to one of my posts there, I try to reply right back to you. But also, new, you can now follow me on LinkedIn. So look for Cameron May on LinkedIn. You'll see me. You'll see the same Scottish castle as my background. And that's another place now to connect with me. So great additional benefit there. But let's get into this discussion. As we do, of course, we need to consider risks. Risks are sort of the point of today's discussion. But as we plan to place this example trade, keep this important information in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only. It should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. Okay, so let's set an agenda for the day. As we do each time, first thing we're going to be doing is following up on some example trades that we already have in our paper money portfolio. So we have four that are, actually we have three, one that was recently concluded. So three that we're going to be taking a look at today. I think maybe each of those three is going to require some attention today. Then we'll take a quick peek at the markets, then get into this discussion of covered calls. And as we do, we're going to set the stage by discussing three big risks that are associated with covered call trading. So why don't you do me this favor? Go ahead, chat and let me know, what do you think those risks might be? List off one or two or three of those. We'll see if our lists match up. But we'll talk through a covered call. We'll explore the risks associated with covered calls. We'll also look at three potential advantages of trading covered calls. Then we'll plan to place an example trade. Okay, so let's go right to Thinkorswim desktop trading software platform. Here are our existing positions. I said there are three current positions and actually a fourth that concluded in between last week's webcast and this one. So we need to follow up on that. But Amazon, first of all, this is a covered call. Bought some shares. Paid $221 for those shares. They slipped a bit. We're at $216. At the same time, we've sold a call. Now, that's not the whole story with Amazon. That's frequently the case with a lot of these symbols. So we'll get the entire story in just a moment. But right now, we've sold a call at the 230 strike. We'd prefer to stay below 230, unless we don't mind getting called out. We're well below 230, so our call has actually fallen in value. That's compensated us somewhat for this drop in the stock price. Let's go have a look at the full history of our Amazon position. So here, we bought some shares at 221.52. Initially sold a call at the 235 strike. We've closed that out already for a $1.40 profit. So that helps out a little bit with the setback that we've taken on the share value. Right now, we're in this 24th of October 230 call position. So that's expiring in just 4 days. We're well below that strike. It doesn't have much remaining value. I think what we might do is maybe roll this one down. Well, maybe not. Maybe I'm not going to roll because there is an earnings announcement that's right around the corner. Rather than rolling, how about we just exit this call? If we collected $1.57, yeah, Mark's saying it's 4 days till its expiration. Maybe it's rolling time. Some traders don't mind putting on a covered call position over an earnings announcement. Others don't like having a covered call in place because it can limit that upside. Spoiler alert for the risks. Anyway, let's go close this one out. So if we're in it for $1.57, if we're able to close out for, let's say, 17 cents, would that be exactly, yeah, look at that. That would be exactly the same profit as the last trade. Yeah, we'll see. Let me right click. Let's create not a rolling, but a closing order. Let's see if we can get out of this for 17 cents. Click confirm and send. Going to buy that call back, trying to get out for 17 cents. If we do, it'll be $17 plus a 65-cent commission. Now, it's giving us a little reminder here. Please note that you've selected a weekly option series with a non-standard expiration date. That's true. This isn't the third Friday expiration. This is a weekly contract. That's all that. That's just a reminder of that. Let's send that order off. And look at that. We did close it out for 17 cents. So we did just make another $1.40. So we've netted $2.80 in total profits on the two calls that we've sold against that stock position so far, minus commissions, obviously. So it'd probably be closer to 279, 278 and a half, something like that. So I'm going to leave that stock position there. Now, a trader here might keep an eye out, though, because we had a nice support level that's been maybe propping up price, or we have broken that support. So a trader may consider whether they still want to own shares at all or not, even if they don't have a call in position. I think we're going to let this roll through that earnings announcement, but there could be a case made for exiting. And how about, let's just do this. Let's do sort of draw a line in the sand. Looks like there's a level of support just below where we are right now. So let's say if this earnings announcement goes poorly, if we break down below that support, we're going to exit. So I'm going to make a note there. Exit if support breaks on earnings. There we go. Might break before, but we'll be back to talk about this after the earnings announcement. But we're done with that position. Let's have a look at our Bank of America position. Here we just have 200 shares. It's because we had a call. We're out of that call. That one, we had an earnings announcement approaching. There was this trade. Bought 200 shares at 50.58. Sold the 51 calls. Those expired for a 107 profit. And then we didn't replace that because we had an earnings announcement. And look at this. The earnings announcement seems to have been well received and the stock has gone up. So we could just see if the stock continues to run. We could sell and take profits on the stock and add those to the profits on the short call. I think we're going to sell another call here, though. Let's say that we're okay if we wind up getting called out, let's say at $53. That would be above the price we sold for, we bought the shares for. It would, yeah, it's even above the previous call that we had. Let's see what we can get for a $53 call at this point. So I'm going to go out to the next third Friday expiration, the 21st of November. The $53 call looks like it's trading between $1.24 and $1.30. Maybe we can get about $1.25, maybe $1.30 at this point. So we have 200 shares. So we're going to sell 2 contracts. Click on that bid price. Let's dial this down to, dial it up from -10 to -2, selling 2 contracts. Naturals at 125, the mids at 130. Let's just try to get $1.25 out of this. I'm going to click confirm and send. Selling the $53 calls at 125. That would be a minimum acceptable credit of $250. We'd have to subtract 2 commissions out of that, bringing the total minimum acceptable credit to $248.70. Let's send that off and see if we can get that to fill. Go to our working orders. So we're asking $1.25, was offering $1.50. So yeah, we actually filled it at $1.27. Cool. So we're in that position now. And we have a similar position as we go back down here on our Visa. Visa, we own 100 shares because we're out of the most recent call. Here's the history of our Visa trade. We actually started this one off selling puts. Those puts expired. We kept 89 cents. Sold some more puts. Those were assigned for $330. So we have realized gains on those two short put contracts. We also have realized gains on this call. We have realized gains on this call. Break even is down here at 320.56. We have a note here to exit if support breaks, and that support's been holding. There is an earnings announcement around the corner on this one, though. So I'm going to leave this one to go through that earnings. Mark says BAC expectations are unusually bullish due to exceptional potential fees on the Norfolk Southern deal. We'll see if that plays out, see what shareholder reaction is to that. Obviously, nobody has a perfect insight into how any earnings announcement will be received, right? Yeah. Okay, so there, we're actually done. So those are our existing positions. There's one other position that we had in place that actually wrapped up. Last week's trade lasted a grand whopping total of 1 day. So here's what we did last week. Actually, if we go to our account statement, if we look over the last 8 days for the symbol NVDA, we had an NVIDIA put, sold a put, the 180 put for $5. That was stopped out. We stopped out at 835. So we have a 335 loss. Oh no, the horrors, it's Halloween all over again. No, actually, NVIDIA has actually treated us pretty well to this point. This one didn't work out. The last two did. So yeah, we originally sold a put that expired for 258 profit. We sold another put, made a 328 profit. This one we sold. We were stopped out. Look at this 1 day. Did we get down 2 days? Yeah, we got down below 180. Yep. We had a stop right at the strike that we sold, 180. So we were stopped out right here. Entered on this day, thinking that a previous high was maybe likely to act as a new price floor. It didn't. Broke down through that. And we kind of teased down through our strike, trade over. Now look what's happening. This is starting to recover. Yeah, Mark says time to talk about NVIDIA. Exactly. This thing had a good time till expiration. This is where a trader, this is just reality. If we're using stops, even on high probability trades, that changes the probability scenario. And actually, the probability of touching a certain level is much higher than the probability of going down below and expiring below that level. So yeah, we turned this high probability trade actually into a low probability scenario, and that's actually how it played out. So, you know, this adds one loss to two previous gains. We're still up overall about $2.50 on our NVIDIA positions, but this is where keeping tabs on one's trading behaviors may allow us to reassess. Was this the right thing to do to put a stop right at that strike? Could we have put it lower? Well, then if the stock continues to fall, maybe the damage just gets worse. There are pros and cons. Anyway, we weigh that out for ourselves and decide how we're going to trade in the future. In the future, I'm probably not going to trade. I'm not going to change the plan dramatically. But that concludes our 4 positions. So let's look at something new. And as we do, let's make sure that we have that backdrop for the trading environment. Another good day on the S&P 500. You take that Friday move out of the equation. This has been a spectacular run since those April lows. Very bullish market that seems to be continuing right into the present day. Could turn on a dime, but let's just say, yeah, an RB Tech trader says we could have used a lower strike. We could have even stuck with the same strike, but put our stop in at a lower level. All kinds of different decisions that might have been made, but that is the benefit of hindsight. We can figure out the perfect way we could have managed something in retrospect, but we made the decision we did, and we're sticking to it, right? Anyway, let's just say that our trader's still bullish. Friday didn't spook them. Yes, October has this scary reputation, but what's actually the tendency? If we've looked at a seasonality chart of the S&P 500 in the past, does anybody remember that chart? What's actually the tendency of the markets from about mid-October through the end of the year? Or if you look at the last 20 years, on average, that's a really strong bullish time. Usually the volatility is done actually by mid-October. I don't know what's going to happen in 2025, but that's the historical tendency. So let's just say that our trader, for whatever reason, whether it's what they see on the chart, it's their personal convictions about the economy, maybe they just look at the seasonality tendencies, they just think, as we plan a new trade, maybe let's go out here to November and add a new trade. They just think maybe prices are more likely to go up than down. So let's go do a covered call. Covered call is a bullish approach to a little bit of capital appreciation with some income potential. So I'm going to go back to a familiar symbol for today's example. Let's go right back to NVIDIA. Yeah, we've been stopped out of one bullish trade, but if we look at things still, if we just take a step back, we did break down through this price ceiling. It didn't act as an immediate price floor. But does that mean that the trend of the stock has changed dramatically? Maybe our trader recognizes, okay, we took some lumps here, but we've come down to an apparent price floor. It looks like we might just continue to rise anyway. So let's do a covered call on NVIDIA, but I want to talk about 3 risks associated with covered calls, because covered calls are described, and I think fairly accurately, as being among the most conservative options trades that might be placed. And for a lot of traders out there, they're used regularly as an income strategy. But there are drawbacks to this strategy. So let's use this as our example. I'm going to buy some shares right now. 183.63-ish. We'll see where they fill. And how about we sell a call with a recent peak up here around 195? I wonder if we could get a decent premium for 195. And we do have an earnings announcement coming up. Let's see if we can get a covered call in place that'll be done before. That's November 19th. Let's go to the trade tab. Look at our option chain. So we were thinking about, the 21st of November. We do have that earnings sort of squeezing in there. How about we look at the November 14th contracts? Let's look at those. What's the 195 trading for there? About $3.50. Okay. That's approaching 2% on this trade. So here's going to be our trade. Sample trade. Call. For this one specifically, we're going to buy 100 shares. All right. We can actually, let's see, that would be about, that'd be about an $18,000 trade. That's okay. We'll stick with 100 shares. Buy 100 shares at around, I'm going to do some really, we don't know how much this is going to fill for. Let's say it's $183.70. Prices are changing. Right now, I'm actually not being terribly generous. We might be able to get it for less than that, but prices are moving as I'm talking. And at the same time, we're going to sell a 14th of November. Let's do that 195 call. And it looks like we might be able to get about, might be 340. Okay, so for visual reference, that would be right up here. Let's see, we said November 14th is going to be our expiration. So that's going to be right here. I'll just draw in a line to represent that expiration. And our strike is going to be right there. Carry that out till expiration. So that sort of tells us the story of this trade. We're just hoping the stock continues to rise. If it rises, that's great. It's helping out the 100 shares that we own. However, let's talk about the drawbacks of doing this sort of a trade, because it can be awfully enticing to look at just this element of the trade and say, wow, so for each 100 shares that I own, there might be $340 of income potential, and it only takes 25 days for that. That's a pretty strong income potential. 2%-ish return for 25 days. Pretty accelerated return. So that we can get a little bit starry-eyed and not be entirely balanced in our view of exactly what we're getting ourselves into. So let's see, guys, what do you think some of the risks are? I know some of you chatted in these risks. Let me give them to you. Here are 3 risks of, and let's abbreviate it to CCs. If you can forgive me, sometimes I don't like to type everything out of covered calls. Number one is that we have limited upside. When we enter into these trades, if I go sell this contract at 195, I'm entering into a contractual obligation where someone else has the right to buy my shares for $195. Now, with just a stock position, if we don't do a covered call, what's the upside potential? Unlimited. These next 25 days that we're going to be in this contract carry with them boundless potential. Our stock can go skyrocketing upward if some great news comes out. And we know NVIDIA can certainly go up if it gets a mind to, right? Well, for the next 25 days, we're essentially selling off all of that potential, starting at $195. Someone else has the right to snag those shares from us at any time for $195. So if those shares go skyrocketing up, if they go to 200, 250, 300, I know that's kind of exaggeration, but it's within the realm of possibility. We don't get to participate in that. That's a real risk. That can really sting sometimes. Okay, so what's number two? Number two is that we have this limited upside. Doesn't mean that we have limited downside. I would describe this as we have huge downside potential still. How much money, if we own 100 shares of stock and those shares right now are worth $183.70, how much can we lose on those shares? We can lose $183.70. Now, obviously, we don't own the shares yet, so I'm kind of skipping ahead. But yeah, as owners, we carry that risk. And you might think, well, but doesn't the other guy have to buy my shares from me? No, they don't have to buy the shares. They have the right to buy the shares. They're under no obligation to buy the shares. So if the shares collapse, they're going to say, Cameron, keep your cruddy shares. I'm not paying you $195 for those. And they walk. Now they might leave us with the $340 that was paid, but that is small compensation. If we're looking at worst case scenario, if the worst thing can happen, NVIDIA goes bankrupt in the next 25 days, is it going to? Probably not. I think we can all say we're fairly confident about that, but could happen. We lose $183 on stock ownership. We get $3.40 from the call. It is small compensation. So both of these are facts when we're trading covered calls. Now, there's a third thing that we might want to consider. As we look at this premium, $3.40 might strike us as a pretty good premium. There are going to be other times, we talked about this last week, made a big deal of it. Other times when the premiums are going to be really juicy. What does that mean? Juicier premiums, higher premiums. If we see higher premiums, those premiums typically equate to riskier conditions. When premiums go higher, it's because the stock is starting to move more violently, or it's expected to start to move more violently within the time frame of the contract. So we have to be aware when we're selling covered calls, if the premium looks particularly good, it doesn't mean that we can't go ahead and sell the call. We just have to realize it's probably because we are sailing on choppier waters, right? So there are three big risks that I want to make sure that we're aware of. And now, obviously, this can sound like I'm trying to discourage covered call trading. I'm trying to do nothing of the sort. I actually don't discourage. I don't encourage any specific strategy. We just try to learn the strategies, weigh the pros and the cons, and then if a trader decides they're going to go ahead with a trade, we want to understand how to actually push the buttons to put a plan into place. So those are three big risks. Let's be a little bit happier now. Okay. What are three big potential advantages of covered calls? And I'm going to look at these. I know I could say, oh, well, there's income. All right, income, I guess, if that's what the trader is really looking for, yeah, that's a potential advantage, but that's sort of obvious. I don't like to always state the obvious. Here's one thing that might be a little less obvious. I tried to think of how I might phrase this. Most of the time the covered call will work better than just. My capitalization's all over the board. Anyway, just stock ownership. Ooh, that's a bold statement. Yeah, it's a bold statement, but it's actually accurate. Yep. Most of the time, the covered call, I want to go with how I phrase this. Most covered trades will have better outcomes than just stock. That's the way I phrased it in my notes. I'm gonna type it out that way. Most covered call trades will have better outcomes and not then just stock. What in the world, Cameron? How can you make such a bold statement? Because the math says that's an accurate statement. Let's look at this covered call that we just decided to sell. And I'm going to make the case, 4 different scenarios, 3 of which the covered call outperforms the stock. Right? Let's do it. Here's the covered call we're selling. I'm going to make the case that our stock is going to do better in all circumstances, except if the stock goes up above 198. What did we sell this for? We haven't sold it. We're assuming a sale of 340. So I'm going to say 198.40. Let's draw on a line up here. 198. It's almost off the top of the chart. Close. That's close enough. There we go. Look where we are right now. Let's throw in some potential scenarios. What if the stock could go up or it could go down? Well, what if the stock goes down? And we're comparing somebody who just owns the stock versus someone who sold the call and also owns the stock. Well, if stock goes down, let's say it goes down to 170. If we just own the shares, we're down $13.70. Well, if we own the shares, but we also sold the call, what happens to that call at expiration? Probably just expires worthless. That goes in the pocket as a realized gain. And we own shares that are down $13.70, but we have a premium of $3.40. That's an improvement. That means that our covered call had a better outcome than just stock ownership. But what if the stock goes sideways? It doesn't go down, it goes sideways. All right, well, if we just own the shares, there's not been a gain, there's not been a loss. But if we go sideways, what's this trader going to do who has the right to buy shares at 195 from us? The shares aren't worth 195. They're probably going to say, Cameron, keep your shares and also keep my premium. My stock is a wash, but I made 340 and a realized gain on that option. That's an improvement. That is a better outcome than just stock ownership. What if the stock goes up? What if it goes up here to 190? Awesome. As shareholder, I made an unrealized gain of $6.30. But with this covered call, I also have an unrealized gain of $6.30. The clock has run out on the owner of the call that I sold. It's still out of the money, expires worthless. Now, could the trader decide, you know what, Cameron, I want the shares anyway? Fine, take the shares. That still outstrips the performance of the stock because a shareholder would be holding on to shares for 190, and I just sold for 195, and I kept $3.40. So why did I say if we stay below 198.40? Let's say the stock rallies and it winds up right at 198.40. Maybe we'll call it 198.41, just to really split some fine hairs. So we're a penny in the money. Pardon me. Nope, sorry. Nope. Back away from that. I don't even need to do the 198.40. Let's just say 198.40. Shares have risen from 183.70 to 198.40. Our shareholder is sitting on a nice fat gain in the stock price, but we had to sell our shares at 195. Ouch! They're worth 198.40. Okay, we sold the shares at 195, but we collected 340 from selling the call. That's a total value of 198.40. That is an identical outcome to just stock ownership. It's really only if the stock goes above that level, 198.40, the strike price plus the premium collected, where stock ownership starts to outstrip this. So yeah. Now the thing is, stock ownership can actually outstrip it by a long. If it goes to 250, now it's no question who had the better trade. It's the shareholder who didn't put a cap on things from selling a premium. Pardon me. So that's one big potential advantage is just the odds improve. The covered call trader is just going to have the better trade most of the time. That's just a mathematical fact. Number two, this is the way that I'm going to phrase this. Break even is better than you think. I was talking specifically about the break even on the covered call. Let me clean up my chart here. Get rid of some of these little lines that are going to be extraneous to this point. Go. What's the break even on this trade? If we buy the shares at 183 and then those shares fall in value by $3.40 and they offset the price that was collected on, or the value that might be realized on the selling of the call, that's just sort of a break-even trade. So the break-even on this trade would actually be $180.30. Let's draw a line in there. So here's today's candle. Let's go down to $180.30. Right about there. It's actually right, pretty coincident with the last one. There's our break-even. I'm going to right-click on that. Let's edit its properties and make it green because it feels good to break even at least. So if the stock falls down there and we we did the covered call, we went to all this trouble, and let's say we go down to $180.30, the call expires worthless, so great, we realize the gain on that call, but our stock has fallen by $3.40, so lost 340, made 340, that's a wash. Why did we even do this in the first place? Barely broke even. Well, guess what? We did better than all the shareholders, because someone who just owned the shares is not at break even. From day one, they're actually down the $3.40, and they didn't have any income to offset that. So sometimes break even is a superior trade. Breaking even is better than we think. Because if we're comparing ourselves, I'll just say if we're comparing ourselves to just stock ownership, it's still an improvement. Better to be at break even than to be down $3.40. All right. Now, a final potential advantage of covered calls is that this income can reduce portfolio volatility. If a stock is bouncing around, just shareholders, they're just riding that up and down. However, when we sell calls, just as we just discussed, on those pullbacks, some of that performance hit can be absorbed by the premium that's collected. In this case, falling $3.40 was absorbed because it was offset, theoretically, by the collection of the $3.40 premium. So let's just write that in here. Income can reduce, I'm going to call it position volatility. That you can extrapolate that out to portfolio. If we have a portfolio of covered calls going on, just a single position can help the portfolio a little bit. So I'll just call it can reduce position volatility, and by extension, potentially portfolio volatility. So yes, there are pros. Yes, there are cons. For some traders, these benefits among potentially others. Hey, RB Tech Trader says, in trading, breaking even is an achievement. Sometimes it can feel that way, right? Rad BCC says, trying to do some planning. How long are these sessions? 1 hour? So these are 45 minutes, with the exception there's one at the end of the week that's 30 minutes. Now, these are 45-minute webcasts. We wrap them up pretty promptly. You should never see one that ever goes beyond, say, 47 minutes. Okay? All right, so there's sort of a nice balanced view. This is not a sales pitch for a strategy. It's not intended to be a scare tactic to dissuade someone from employing a strategy that's attractive to them. I think just the trader always needs to see the potential advantages and the potential disadvantages of a strategy before really placing a trade. So let's go do our trade. So I'm going to go to the 14th of November. That's before earnings. By the way, earnings are a good example of this point. If we sold an earnings that are, or if we sold a trade that's out here, let's say, was that an after? I didn't even notice. Let's go have a look. That earnings event is, oh no, it's on the 19th. Okay. Yeah. If we were to go here to the 21st of November, we're probably going to get a far juicier one. Yeah, look at that. If we just went out another week, we could more than double, no, not more than double, that's an exaggeration, but increase the potential premium by like, what is that, 70-ish% going from 340 to 580, huge increase for just selling a little bit longer contract. Why is that? It's because there's a significant additional risk in selling a covered call over an earnings announcement. So yeah, a juicier premium almost always is associated with greater risk. Right. So let's go back to the one that we were planning. Go to the 14th of November. Let's go to the 195 strike. And we're going to right click on the bid or the ask. It doesn't matter which. I just want access to the menu that gives me the option to buy a covered stock. Covered stock just means covered call on Thinkorswim. So let's buy, just do one contract and 100 shares of NVIDIA. Net cost right now might be around $1, $180.20 or 30 cents. Let's say we're willing to spend more than that. I just want to make sure that we can have a good chance to get filled while the camera's on. So let's crank that up and say we're willing to spend up to $180.35. Let's click confirm and send, buying a covered call. The 14th of November weekly contracts. Please note that you've selected a weekly option series with a non-standard expiration date. Yep, we know that this is expiring on the second Friday, not the third Friday. Selling the 195 call. 180.35 is where we're setting our limit. That's giving a max profit. There's that limited upside with huge downside. There is a commission to be paid here. Let's send this off, see if we can get this filled. There we go. Yeah, filled it for 180.31. So it was worth kind of dialing it up to 180.35, gave us a better chance to get a fill. And we filled. So what did we get? If we go to our filled orders, we can see we paid $183.71 for the stock, and we did get that 340 premium. So there, that'll give us our break even down there right at about a penny above the break even that we were discussing, 180.31 instead of 180.30. Great. All right, everybody. Well, we've accomplished what I set out to do today. I thought, let's talk about the dark side of covered call income strategies. So we've talked about that, but there's a ray of hope out there. We talked through 3 potential advantages of the strategy as well. I hope that was helpful for you. Hope it gave you some different insights into what's probably a familiar strategy for a lot of you. But guys, this is what we do on Mondays. I hope you'll put it in your calendar to come back and join me again next Monday, or just watch for next Monday's video. That's fantastic too. But I have some suggestions for you to make sure that you're aware of the full range of educational resources available to you, including the new one that I already teased at the start of this webcast. So first of all, make sure that you are subscribed to our Trader Talks Schwab Coaching webcast channel on YouTube. You can just click on the subscribe button down below the video here. It doesn't cost anything to subscribe. It only takes a second, but this is where you can go join our live streams. You can also find the playlists for our previous webcasts. So for example, if you wanted to see our trading covered calls and short puts playlist for the entire series, click on playlists, scroll down about toward the middle, just off here to the right toward the middle. There's trading covered calls and short puts. You can click on view full playlist, and you can see last week's discussion where we talked about many premiums are much higher for selling options right now, but why? So that was another important risk discussion. Another suggestion I would make is that if you have an account on X, you should be following your favorite Schwab presenters there. But I have an alternative for you, though. Keep your eye out, though. If you have an account on X, give us a follow. You can follow Barb there at Barb Armstrong CS. You can follow me there at Cameron May CS. And if you reply to one of my tweets or posts, I try to reply right back to you. I can provide, we can have little conversations about the markets here, but also I even let you know what I'm doing on the weekend. Yeah, it is college football season. I went to the big showdown between the intrastate rivals, University of Utah and BYU Cougars. Great game, 24-21. That's just what you want to see from a rivalry game. Anyway, best place to connect with us is there on X. However, if you don't have an X account, you can also follow me on LinkedIn. This is brand new. It's only the second time I brought this up. Yeah, so I'm now posting on LinkedIn. There's my profile. There's the Scottish castle in the background. That's Doune Castle. And there's me just sort of sitting on a bench looking professional. But give me a follow here. Only 28 people to nudge your elbow space with. So kind of a more intimate connection available there on LinkedIn at the moment. I'm sure that number is going to be increasing rapidly. But yeah, give me a follow on LinkedIn. And if you reply to one of my posts there, I'll try to reply right back to you there as well. All right, but Barb, thanks for helping out in chats. That's very much appreciated. Everybody, thanks for giving me your time today. Go enjoy the rest of our videos that we have, or our webcasts that are going to be coming up over the course of the next several hours. I will look for you again in next Monday's presentation. I'll look for you on X. I'll also look for you on LinkedIn. But wherever I see you again, until that moment arrives, I want to wish the very best of luck. Happy trading. Bye-bye.